Ever feel like the stock market's, well, kind of rigged? Like there are these players, with almost like superhuman speed and knowledge, and they're tipping the scales. Well, you're not far off. Today we're going deep on high-frequency trading, HFT, where algorithms are making, get this, thousands of trades every second.
Yeah.
Exploiting these tiny market discrepancies, these little things that vanish faster than a snowflake on a hot stove, really.
It's that speed that's really key.
Right.
We're talking about algorithms that can spot an opportunity and capitalize on it in milliseconds.
It's mind-boggling. We're going beyond the basics today, right?
Yeah.
We really want to look at the actual signal.
Details.
Yes, the tells these algorithms use to get that edge.
And it can get pretty complex.
Oh, I bet. But that's what we're here for. And our sources point to this strategy called FAD logic as like a core principle.
It's counterintuitive for sure.
It sounds kind of risky.
Imagine like betting against the trend, fading the hype almost.
So if everyone's buying, these algorithms are selling.
In a way, yeah. But it's more nuanced than that, of course. Our sources indicate, though, that within specific setups, this FADA logic, it can be surprisingly effective.
Like, how effective are we talking?
Well, some studies suggest over 70% success rates.
Wow, that's huge. All right, so let's break this down, this FAD logic. How does it actually work in the real world?
So our sources, they point to 4 main HFT signals, each one using FAD logic a bit differently.
4. Okay, so let's take them one by one. What's the first one?
The first one combines FAD with something called market making.
Market making, right. So that's like ensuring there's always a buyer or seller for a particular stock.
Exactly. Yeah, like a shopkeeper making sure there's always, inventory. So picture this. A huge sell order hits the market, way bigger than usual.
Okay, so the price drops, basic supply and demand, yeah.
Right. But here's where FADE comes in. If the overall market sentiment, the bigger picture, is still bullish.
This sudden drop, it might just be a blip.
Exactly, a temporary overreaction.
And the algorithm sees that as an opportunity.
Bingo. Our source calls this HFT buy signal 1. Basically, significant sell-off, price plummets, but market making is positive. Buy signal.
They're buying low, hoping to sell high when the price bounces back.
You got it.
Yeah.
They're capitalizing on that short-term fear.
Wow. So it's like they're trusting the long-term trend, but exploiting these little
Hiccups.
hiccups, yes. And I assume the reverse is true, too.
Absolutely. Bearish market, huge buy order, inflates the price. That's HFT sell signal 1. Short the stock, anticipate the correction.
Fascinating. So they're really playing both sides.
That's the name of the game in HFT.
It's like they have this sixth sense or something.
Well, more like a really, really good algorithm.
Yeah.
And that brings us to our next signal, which deals with something called iceberg orders. And that's where things get really interesting. Iceberg orders. It's almost like something out of a spy movie or something.
Right. They sound kind of mysterious.
They're all about hiding your tracks. Imagine you want to buy or sell a massive amount of stock, but you don't want to spook the market, right?
Yeah. Because if everyone sees this huge order, they're going to freak out.
Exactly. Supply and demand go haywire. Price swings like crazy.
Yeah.
So you use an iceberg order. Only a small part, the tip, so to speak, is visible.
The rest is like hidden beneath the surface.
Exactly. It's automatically filled as the visible orders go through.
Sneaky. But how does an algorithm even detect that? I mean, if it's designed to be hidden.
They look for the subtle clues, the little inconsistencies. Like, let's say there's this big sell order, right? Price dips, sure, but not as much as you'd expect given the volume.
So that could be an iceberg, holding the price up a bit.
That's HFT by signal 2, or by iceberg, as our sources call it.
So the algorithm sees that muted reaction and...
By then, knowing that eventually that hidden part of the iceberg is going to push the price back up.
They're using the iceberg's own weight against it.
You could say that, yeah. Of course, the opposite is true, too. Big buy order, small price impact, sell iceberg.
Wow, okay. This is getting pretty wild. But what if those large orders aren't just, well, hidden? What if they're actually, manipulative?
Yes. Signal 3. FAE logic plus, as our source puts it, execution manipulation.
That sounds, I don't know, kind of shady, right?
Well, it's where things can get a little murky. We're talking about the possibility that the price impact of a trade, it doesn't quite line up with what we'd expect. It's like almost too perfect.
You mean like intentionally creating a false impression of how the market's moving?
That's the idea. HFT by signal 3 is a good example. Imagine a huge sell order, but instead of dropping, the price, it goes up.
Wait, that doesn't make sense.
Right. It's counterintuitive. But it could be a way to lure in buyers. They see the price going up. They think it's a sure thing.
And they jump in at the worst possible time.
Exactly. And then, boom, the manipulator sells off their shares at this inflated price, and everyone else is left holding the bag.
That's ruthless.
Effective, but yeah, not exactly ethical. And the reverse applies for HFT sell signal 3. Big buy order, price tanks, scare off buyers, scoop up cheap shares.
So it's like a constant battle of wits out there.
Oh, absolutely. These algorithms are always trying to outsmart each other.
And we're caught in the middle. Okay, so speaking of smart algorithms, our sources mentioned this fourth signal that, well, it adds another layer to all of this. Fade logic with 3D divergences.
Sounds more complicated than it is.
It sounds pretty complicated.
Think of your typical stock chart, right? Price and time. Now add a third dimension.
Like volume, maybe?
Exactly. Or any other relevant indicator.
Yeah.
It gives you this richer view of what's happening.
So we're not just looking at a flat image anymore. We're like rotating a sculpture, right?
Sure.
Getting the full picture.
Yeah, that's a great way to put it. You start to notice things you wouldn't otherwise. Like imagine the price of a stock is going down.
Right.
Classic downtrend.
Everyone's freaking out.
Exactly. But then you look at it through this 3D lens, factoring in volume and other indicators.
Mm-hmm.
And you see that the slope of the price line, it's actually going up.
So the price is dropping, but there's this underlying strength that's kind of hidden.
That's HFT buy signal 4 in action. The algorithm spots this divergence, this disconnect between what people are seeing and what the data is actually saying.
And they buy while everyone else is selling. They're fading the
panic. Exactly.
Wow. So it's like these algorithms are, I don't know, speaking a different language or something, seeing things that we just can't even perceive.
They're definitely operating on a different level,
Yeah.
which is why it's so important to at least be aware of how they work, right?
Right.
Even if we're not all going to go out and start coding our own HFT algorithm.
Right. Because it's not just about the tech, is it? It's the humans behind it, the ones creating these algorithms and well, profiting from them.
Exactly. And that's where things get a little, well, ethically tricky sometimes. Because these strategies, they can be incredibly profitable, as our sources make clear. But they're not without risks.
It's like high risk, high reward. Right.
That's one way to put it. And our sources, they really emphasize the need for really solid risk management in this world.
Because one wrong move and
It could be disastrous.
yeah.
You need the right tools, the right safeguards.
Like what?
Well, our sources mentioned this platform, quant. It's specifically designed for HFT.
Okay. What's so special about it?
It's got all these features built in, like risk management tools, trade filters, even like an auto exit function. So if things start going south,
Pulls the plug.
exactly. It's all about mitigating those risks.
So it's like having like a safety net, even in this crazy high speed world.
Exactly.
Yeah.
Because as we've seen with these FADE signals, the market, it's unpredictable. It's constantly changing.
You can't just set it and forget it.
No, you got to be paying attention. You got to be able to adapt.
Well, that's reassuring, I guess. But it also kind of makes me wonder, as these algorithms get more advanced,
Yeah.
as they learn and they get faster, what does that mean for the average investor? Like, are we even going to be able to keep up?
That's the $1 million question, isn't it? And there's no easy answer. But I think the key takeaway here is knowledge, understanding how these systems work. Even if you're not directly involved in HFT, it's more important than ever.
So we can't just bury our heads in the sand.
Exactly. We got to educate ourselves. We got to ask questions, and we got to demand transparency.
Yeah.
Especially when it comes to things like potential manipulation, right?
Absolutely, because this is our money we're talking about, our financial future.
Exactly. And we have a right to understand how it's being traded right.
Right. Well, on that note, I want to thank you and all of our listeners for joining us on this deep dive into the world of high-frequency trading. It's a complex landscape for sure, but hopefully you've come away with a better understanding of how it works, the potential risks and rewards, and most importantly, what it means for you. As always, we encourage you to do your own research, stay informed, and as we've said throughout this episode, never stop asking questions. Because in the world of finance, knowledge truly is power.